In this video, we're going to talk about how to calculate the change in pension plan assets. So when you look at the balance sheet of a firm and you see something like pension liability, that's the funded status of the plan. And we've talked about that before. That's basically the net of the projected benefit obligation of the firm, which is the present value of all the benefits the firm is going to have to pay ultimately to retirees. It's the net of that and the fair value of the pension plan's assets. So what the pension plan assets are, it's basically just a pool of assets, right? It's a pool of assets. This could be invested in a market index fund or something like that, stocks, bonds, etc. So there's a pool of assets, and these assets earn a return, right? So there's a return on those assets, and ultimately this pool of assets is intended to satisfy the PBO, the projected obligation of a firm to its employees after they've retired, right? So with a defined benefit pension plan. Now this pension plan, this fair value of plan assets, can change and will change from year to year. So I just want to talk to you about how you go about what are the things that would change the fair value of plan assets. If you know, for example, the beginning balance, how would you get the ending balance of the fair value of plan assets? So let's say that you have a company called Ventriloquists Incorporated. So you started this company and you basically rent out or hire out a team of ventriloquists to perform for schools, weddings, and so forth. And so you're worried about your team of ventriloquists. You want to make sure they're able to retire. So you start a pool of assets. You've got a defined benefit pension plan here for your ventriloquists, and we know the beginning balance. The beginning balance of that plan is, let's say, $200,000, and some things happen during the year, and we want to know what the ending balance of this fair value of the plan assets is going to be. So first thing we need to know is what was the actual return on the plan assets during the year. And let's just say that it was 8%. Okay, let's say 8%. And so that would, based 8% return on $200,000 is going to be $16,000, right? So that is going to increase. This $16,000 is going to be added to the beginning balance. It's going to increase the fair value of the plan assets. And that makes sense, right? We have a pool of $200,000 worth of assets. We earn a return of 8%, which is $16,000. Now we're going to have a bigger pool of assets, right? So now the fair value of the plan assets will be increased not just by the return, but also by any contributions made to the plan. So for example, the employer says, okay, hey, I need to make sure that there's enough pool of assets here to be able to pay the retirees after they've retired, right? So they have to put money into the plan. They can't just wait for the return to happen. They also have to make some contributions to the plan. And also the employees themselves might make contributions, right? But let's just say that between the employees and the employer, that there ends up being $14,000 in contributions made to the plan, right? So that's, instead of just saying this $200,000 pool of assets is earning a return of $16,000, in addition to that, there was an additional $14,000 put into the pool, right? It was just put directly in. That's our contribution. So obviously, if we contribute assets worth $14,000, we're going to add that. That's going to increase our beginning balance as we go to calculate our ending balance here, right? It's going to increase our fair value of the plan assets. Now, we are going to have to make a subtraction, though. We're going to have a deduction if we make any payments to employees who are already retired, right? Because remember, the whole idea of setting aside this pool of assets is to be able to make payments to satisfy this PBO, right? And what is a PBO? It's just basically saying, look, when our employees retire, we're going to have to make payments to them, right? And so those payments are going to reduce our asset pool, right? Because the payments are coming out of the asset pool, so it's going to reduce the asset pool, okay? So let's say that there was $31,000 in payments to retirees, okay? Now, we can go ahead now and calculate the ending balance of the fair value of plan assets. So that's going to be $199,000. So if this was, let's say, January 1st that we had the beginning balance, then December 31st, the end of the year, we have the fair value, and again, this is the fair market value. The fair market value of our pension plan assets, this pool we've set aside, is $199,000.